Hello everyone, welcome to Basics of Options series. In this series, we are going to explore a lot of concepts, of which the first one we are going to explore is Volatility Index, which is also called as VIX. So, what is Volatility Index? Let's quickly dive in. It is a factor that denotes the price movement of an index over next 30 days. I will give you an example of how it works in the next slide. But let's try to understand what is VIX. VIX is how much a price can move in next 1 year, right? And that is calculated for next 1 year. But then for a month or for next 45 days, you have a formula to calculate how much it can move in next 15 days, 30 days, or 45 days. So it also talks about what are the probabilities of price ranges, like what is the upper band and what is the lower band. How much can we expect it to move, right? The concept was first introduced by Chicago Board of Options Exchange (CBOE) in 1993, which was subsequently adapted by NSE in India in 2003. So we have our own volatility index called India VIX. So, what are the significant aspects of this? It helps us as a buyer or as well as a seller to make well-informed investment decisions. Whether something is going to fire up or it's going to go down, you can read the sentiments of a particular index through VIX factor alone, right? It is one single factor that can reveal a lot of details. And now, if we look at how it is done, one of the consideration is that it calculates all the OTM contracts. We will talk about what OTM contracts and what is call, what is put. We will discuss all of it. But I took this topic specifically because it is one of the things that you should understand as a first step in order to begin your options journey. First of all, you are entering into options because of its volatility, right? Suppose you are buying shares of SBI, you expect it to move, say, 5 rupees or 10 rupees in a given day. But an option can jump from 100 rupees to 200 rupees, 250 rupees sometimes. Even it can go from 500, it can become zero. So everything is possible in options. That's why it's called options. So one of the factors that determines the price movement is VIX factor, one of the key factors to consider. Right. So how it is calculated? It is calculated based on all the strikes that's been traded and of current week expiry and nearest all open expiries it considers and then gives weightage to that, and the basis which there are some complex formulas which we don't have to really need to know how VIX is arrived, but how to use that is more important, right? So we will explore how you can use VIX to your trading journey. So VIX is defined as the annualized perception. For example, if I say VIX is trading at no VIX is at 12, which means in this year I am expecting the index, which is our index is Nifty. This Nifty is expected to move 12 percentage on the upside or 12 percentage on the downside, right? That is for the year. But can I use that information to find out how much can it move in next week? How much can it move in next month? So that is something that you can use as a range projection tool, right? And it is also a very good indicator to identify the market sentiments. Now, what do I mean by market sentiments? There are specific, ranges over historically, if you look at it, we consider, high value of VIX means high volatility, we can expect market to move from, suddenly 100 rupees can become 200, and then from 200 it can become 50, and again from 50 it can become 300. All sort of, price actions can happen in an high volatile environment. In a low volatile environment, something, can be just, very frustrating. There won't be much of movements. Maybe something you purchased at 100 rupees, it hardly moves between 92 to 108 for maybe couple of hours, so it could be a very frustrating journey. So whether we are trading in a low VIX environment or high VIX environment, tells you what sort of strategies that you can choose to deal with that environment, right? So let's move forward. What are the good levels of VIX? If we consider 14 or less than 14 as generally considered to be a low volatile environment, between 14 to 24 is considered to be a very healthy environment. It offers a lot of opportunities both for the buyer as well as for the seller. And anything above 24 usually is considered to be an high volatile environment, and it involves high risk, right? Maybe you purchase something at 500 rupees, in within next 15 minutes it can become 1000, and next 15 minutes it can come to 750. It's an extremely high volatile environment. I believe some of you started the trading journey in the month of March 2020, the COVID time, would have seen that environment. And right now, what we are experiencing is a low VIX environment, where market is having the VIX levels between 10 to 12, right? For last 3 4 months at least. If I consider 13 or 14, then we last 8 months we are trading in this range itself, and that's pretty strange. So usually when market goes to low volatile environment, it stays there for some weeks, probably to a month, and then it quickly bounces back to the healthy environment. And if it goes to high volatile environment, it takes some time, and then it slows down maybe a month or two, and then it comes back to healthy environment. But what we are seeing right now is market consistently playing in a low environment for more than 6 months. That's something very strange, and that's the game we should equip ourselves to. Right. Let's move forward. So, how do we make sense of these, VIX factor? So, as of today, that is 7th July 2023, Nifty is trading at 19,325. This is where it closed. And India VIX closed at 11.53. Now, if I have to project the price and then say how much it can move, so this 11.53 percentage is expected to move for the year. It's not for the month, right? It's for the year. But I wanted to compute how much it can move in next 30 days, right? So there is a formula. The formula is VIX divided by square root of time. Time is in months. How many months that you are going to consider? Maybe 2 months. Then you will have to divide it proportionately. I'll talk about that in a bit. But the formula is VIX divided by square root of t. That is the formula. And let's go and then explore this. So, like I said, the price range here, if you see, 11.53 is the VIX, right? The VIX is 11.53. Square root of t is, this is 12 months, right? In a year, 12 months we have. I'm doing this because I wanted to find out what it is for 1 month, because this is the 1 month. If I have to find for 1 month, then I have to divide it by 12, right? Only then I will get what it is for next 30 days. So 11.53 divided by square root of 12, which is 3.464. So 11, which yields 3.329 percentage. And currently I said the Nifty spot closed at 19,325. So I am expecting a price range of 19,325 into 3.329 percentage, which is 643 rupees. So 643 rupees is the range. Now I have to find the upper band. The upper band is plus 643 on the spot, which is 19,968 is the upper band I am expecting the market to reach in next 30 days, not for the year, for the next 30 days. On the downside, I expect the market to be trading at 18,682. So this is where I expect the market to trade, right? If I have this information as a writer, probably I can write 20,000 call option and probably 18,600 or 700 put option. I mean, what is a call option, put option? I will definitely talk about that. But considering the larger audience, I assume that most of you know what it is. Still, there is possibility that somebody wants to totally learn it from the scratch. I will make videos on explaining all these concepts. For now, just understand how the price range works, right? Like you are able to predict the upper band and the lower band using this formula, right? So as a buyer, you can make some well-informed decision. You know that once it if it is trading at a very extremely low price, probably whether the price is you know cheaper or um, you know expensive basis where the market is trading on a particular day, right? Like if the market is already gap opened, like Monday the market opens from 19,325, if it is opening say 19,900, it has already like jumped so much. It doesn't make any sense to enter onto the call. I mean, it doesn't make any sense to buy that, right? Because it has already reached towards the end of the spectrum. Now, if you invest more onto that, there is a likely chance that the market may fall. So you don't want to play at the edge of the ranges as a buyer, right? So that, and similarly, if it has opened at 18,600, certainly this is a good place to enter, right? Like you on Friday today, it closed at 19,325, and suddenly you are seeing 18,682. It's a fantastic area to buy, right? So that's how you can predict the price ranges. So there are certain things that you should keep in mind. One, the volatility changes, the way that the prices move changes dramatically on even days. So what are even days? Say that SBI or Infosys or TCS is releasing their corporate results that could have significant impact on uh, the movement in the market. Some political news or economical news, some sort of disaster, some man-made disasters as well. If it is going to affect globally, it's going to cause a lot of changes in the market. The movement and the volatility will increase proportionately. But having said that, don't take these ranges too literally, because uh, there are many other factors in establishing a price range prediction. One of the vital and quintessential factor to consider is VIX, but that alone cannot be taken to determine the price ranges. So what are the other factors? That's scope for our next topic. I hope this was useful. Stay tuned. Thank you.